Most Australians are taught to work hard, save their money in a high-interest bank account and wait for retirement. But here's the cold, hard truth. While your money sits in that bank account, it's actually losing value every single day. Thanks to inflation, the $100 you have today won't buy the same amount of groceries or petrol in 5 years' time. But what if I told you that with just $500 and the smartphone in your pocket, you could start building a portfolio that grows while you sleep? I'm talking about turning a few $100s a month into $1 million nest egg over the long run. G'day everyone, I'm Luke and welcome to Luke Invest Australia. Today I'm breaking down exactly how to start investing in the Australian stock market from scratch. No confusing jargon, no Wall Street fluff, just a straightforward step-by-step guide for everyday Aussies. By the end of this video, you'll know exactly which buttons to press to buy your first share and how to keep the ATO happy while you do it. Let's get stuck in. Before we spend a single cent, we need to understand what we're actually doing. When you buy a share or stock, you're literally buying a tiny piece of a real-world business. Think of a company like a giant block of Cadbury chocolate. If that company decides to go public on the Australian Securities Exchange, the ASX, they chop that block into millions of tiny pieces. When you buy one of those pieces, you're a shareholder. If the company does well, your little piece of chocolate becomes more valuable. Now, there are two ways you actually make money here. First, there's capital appreciation. This is the classic buy low, sell high. You buy a share in a company like Woolies for $30, and a few years later, it's worth $45. If you sell it, that $15 profit is yours. The second way, and this is a favorite for us Aussies, is dividends. Some companies are so profitable that they share their earnings with you. They'll literally deposit cash into your brokerage account just for owning the stock. It's like getting a thank you bonus twice a year. But Luke, is it risky? Absolutely. The market goes up and it goes down. But history tells us that over the long term, we're talking 10, 20, 30 years, the Australian market has returned an average of about 9% per year. The trick isn't avoiding risk, it's managing it. If you're just starting out, picking a single company like Tesla or Qantas can be a bit like betting on a single horse at the Melbourne Cup. If that horse trips, you lose your money. This is why most beginners in Australia should look at ETFs or exchange-traded funds. An ETF is basically a basket of hundreds of different companies bundled into one single stock. Instead of trying to guess which individual company will win, you can buy the Vanguard Australian Shares Index ETF, known as VAS, and when you buy one share of VAS, you're instantly invested in the top 300 companies in Australia. You own a bit of the banks, a bit of the miners, and a bit of the retailers. If one company in that basket fails, the other 299 are there to pick up the slack. This is called diversification, and it's the closest thing to a free lunch in the investing world. It lowers your risk while still giving you those solid market returns. You aren't trying to beat the market, you're simply owning the market. To buy these shares, you need a middleman called an online broker. Now, in Australia, we have a very specific system that is actually one of the safest in the world, but most beginners miss it. It's called CHESS sponsorship. When you sign up for a broker like Moomoo or CommSec, you want to make sure they are CHESS sponsored. This means the ASX keeps a record of your shares under your own unique HIN, holder identification number. Essentially, the shares are registered in your name, not the broker's. If the broker goes bust tomorrow, your shares are still yours, tucked away safely on the ASX exchange. Non-CHESS brokers use a custodial model where they hold the shares on your behalf. It's often cheaper, but it's an extra layer of risk most people don't want. When choosing a broker, look at three things. Number one, fees. How much does it cost every time you buy or sell? Some charge $2, some charge $30. Number two, ease of use. Is the app easy to navigate? And number three, features. Do they have auto investing? This is a game changer for beginners because it takes the emotion out of it. Personally, I use Moomoo because the fees are incredibly low, around $3 for Aussie trades, and it's fully CHESS sponsored. Plus, they have a massive amount of research tools if you eventually want to dive deeper. Now, let's talk about the money. How much do you actually need? In Australia, there is a rule called the minimum marketable parcel. For your very first trade of a specific stock on the ASX, you generally need to invest at least $500. After that first $500, you can usually add smaller amounts, but that first buy button requires $500,000. To find that money, I recommend the 50-30-20 rule. 50% of your take-home pay goes to needs, like rent, groceries, and rego. 30% goes to wants, Friday night drinks, Netflix, that new pair of Nikes. 20% goes straight into your wealth building bucket. If you take $500 today and add just $500 every month into a diversified ETF, assuming a 10% return, in 30 years you're looking at over $1 million. The wild part? You only actually contributed about $180,000 of your own money. The other $820,000 is pure compound interest, the market doing the heavy lifting for you. This is why the best time to start was 10 years ago, but the second best time is today. Let's get practical. You've downloaded your broker app, you've linked your bank account, and you've moved your first $500 across. What now? Search for the ticker symbol. For the Australian market, let's use VAS as our example. You'll see a trade button. When you click it, you'll usually see two main options, market order and limit order. A market order is the I want it now button. You buy the shares at whatever the current price is on the ASX. It's fast and simple. A limit order is the I'll buy it if it hits this price button. If VAS is trading at $103, but you only want to pay $101, you set a limit. If the price drops to $101, the app buys it for you automatically. Pro tip. The ASX is only open from 10 a.m. to 4 p.m. Sydney time, Monday to Friday. If you try to place a market order at 9 p.m. on a Sunday while you're watching the footy, it won't go through until the market opens on Monday morning. Just remember, for that first Aussie trade, make sure your total is over $500 plus the small brokerage fee, or the trade will be rejected. Now, we can't talk about investing in Australia without talking about the tax man. There are two main things to remember. Capital gains tax and dividend tax. If you sell your shares for a profit, the ATO wants a cut. However, here is a massive tip. If you hold your shares for longer than 12 months, the ATO gives you a 50% discount on your capital gains tax. This is a huge incentive for us to be long-term investors rather than day traders. For dividends, even if you choose to reinvest them automatically, they still count as income for that financial year. Keep your statements. Most modern brokers will actually send this data straight to the ATO for your tax return, making your tax return a breeze. But it's always good to double check.